Good morning, Don. Good morning, Laura.
Hey.
Welcome to our last session, Financial Planning 2. Laura is our presenter today, and she is a CFP financial planner.
And Pete, before we go there, I'm going to, as I always do, monitor the Q&A. And so I'm going to disappear and we'll come back with questions along the way as needed. And bye. See you later.
All righty. Thank you, Don. We're not going to go through your Ask First form, but I think it's really important for people to do so. How many licenses do you hold, Laura?
Just the CFP license.
Yeah, and that's a private license, which stands for the Certified Financial Planner license. What is the difference or maybe this is too early, you tell me. What is the difference between a financial planner and somebody who just does investments?
So I can tell you what the difference is, but lots of people are calling themselves a financial planner and they're not really doing financial planning. But financial planning is, the traditional concept of it is kind of 6 or 8 pieces, including, tax planning, insurance planning, retirement planning, estate planning, cash flow planning, and then all the little odds and ends of education funding. All of that is part of financial planning. And I always describe the investing part as the engine that drives all the other stuff, but the other stuff and putting that all together is as important or more important than the investing piece. And most advisors aren't going to review your auto and homeowners insurance for you, for example. Yeah. And that's something a CFP would normally do.
Yeah, you've been listed
actually doing financial planning, which isn't all of them.
You've been listed as one of the top financial planners in the country. You have taught others financial planning. You operate a boutique financial planning firm in Newport Beach and I believe Arizona. Talk a little bit about your practice. How many employees do you have? How much do you have under management? How much do you charge?
So I've been doing this for about 40 years. And
by the way, you don't look it.
Thank you. And at this point where we don't take on a lot of new clients, we have a minimum 5 million liquid assets, typically 10 million net worth or so. We only have about 115 family groups, and I'm still using numbers from the end of last year because I can't really bear to look at the numbers right now, just like you can't bear to look at your investment accounts. So we were right over $1 billion in assets under management at the end of last year. So a little bit less this year at the moment, time and point. And we have 10 employees.
And how do you charge?
And so charge just fees, occasionally a flat fee, and it's a large flat fee with it's typically 20, 30,000 or more if we're charging on a flat fee basis. But like most people in our industry who work the way that we do, we charge mostly on assets under management. And the fee is a high of 75 basis points or 0.75% and goes down depending on the asset level, or goes, or is closer to that 75 basis points depending on the complexity of the situation and what we're doing.
Should everyone understand exactly how you pay your financial advisor?
Yeah, for sure. And it's always surprised me that people seem to be very uncomfortable with talking about fees, and your advisor or prospective advisor, when you're interviewing someone, should be upfront about that. If somebody doesn't ask, we want to bring it up to make sure that they understand. It's common on the sales side of the business that the fees aren't disclosed, and all the time we hear about people telling the client, this annuity, there's no charge for it. We're not charging you. Don't worry about that. It's no cost, no load. There's no fees. And, there are always fees. There's always a cost, to put up those big buildings that the banks and insurance companies put up. So it's very important to understand that and drill down on that.
Okay. Just we don't lose half of our audience because many of us don't have 5 million in investable assets. Is the process for people who have 500,000 to $1 million different than somebody who has $5 million plus investable
The
assets?
process is not different at all. It's all the same issues are there. It's just, yeah, an extra zero or so on the assets doesn't really change the process. And you really need to go through all those steps. The less you have, the more important it is to be sure that you're really getting financial planning and not just the investment management. And if you've not experienced that, if you've only worked with somebody who's doing, working on the investment side, you really don't, it's hard to know what you're missing until you experience it. You're not going to get that from going to the retail branch of a Schwab or a Fidelity or, Bank of America, Wells Fargo. They just aren't equipped to do that. They serve thousands and thousands of clients.
If at the end of the program, you're going to have your contact information. And by the way, it is on our website. We had just a FYI, we had heard from some of our attendees that it was kind of difficult to download material. What we have done, we have upgraded our website. So hopefully going forward, if you had some problems in the past, hopefully you won't experience that in the future. But you can download today's outline from our website, and all of her contact information will be on there. Will you, if somebody emails you and say, can you recommend a financial advisor, will you do so, Laura?
Yes, I'm happy to do that. I usually get several inquiries after doing this, and please, I encourage you to do that. Give me as much information about your situation, financial situation, age, what your concerns are, and I can provide a few names. Pete's obviously a good source for that too, but I've taught over 1,000 of the certified financial planners here locally in Orange County over many years. And so I know most of the people out there, and there aren't a lot of good ones, but there are enough good ones out there. And it's really, really, really important who you work with.
Yeah, it really is. I'm a professional fiduciary in real life, and I only use fee-only fiduciary advisors because you need a plan, and you have to understand what you're spending, and there's a lot of risk in the market. There's a
lot of conflicts of interest in the industry as a whole. So it's really hard. And I just want to say about that fiduciary thing, which is so important, and yet everybody's using that term. And so you have to kind of be careful. I mean, you really have to ask about the licenses and how people are paid. If they have an insurance license still, it's very likely that you're going to be pitched an insurance or an annuity. I mean, they shouldn't have any of those licenses. It's not a good thing to have a bunch of licenses. It's a bad thing, yeah. Which seems a little counterintuitive.
It's kind of, yeah, exactly. Why don't you, let's say I start on the outline. Why don't you screen share? But before we get into your outline, talk a little bit about what's happening today in the marketplace, because like you said, you're getting a little nervous just to even look at your own statements. So talk a little bit about that.
Yeah, well, I guess before I do this, sorry. Yeah, so what's happening now is actually part of a normal market cycle. It's been a rough year for sure. But not at all unexpected given where we are, how the Fed has handled things. I don't think very many people are happy with the Federal Reserve right now. There was so much stimulus money thrown at the economy over the last couple of years that we were bound to be in this situation. And then, there's a lot of a question about how well it's handled with a quick rise in interest rates. But it'll play out in the market. The fundamental financial system is strong. Unlike in 08, 09, there were other issues there, other questions. This is really just a normal part of the cycle. And, we're thinking we're in the last innings of it, that we've seen the worst. But, there are many times in mid-year where the market's down 20%. It's completely normal. Long-term, you make money in the stock market by staying in and writing out the ups and downs. There's no, when somebody says the market's gone down 20%, what's our strategy now? Or how should we change our strategy? You don't change your strategy because it's not something that's unexpected. That about approximately every 4 years, you're going to have a down year in the market. We all got spoiled for the most part. We had many good years, but you remember how scary it was at the beginning of the pandemic and how far the market went down so fast. And, it recovers, it recovers, and it always does over 100 years plus. And there's
can you give us a date when it recovers?
No, that's why we don't try to guess that. Nobody knows. And the longer I've been doing this, the more I don't know.
You can
Anybody who tells you they do. I
You-
know you really, that's what you really want to believe, that there are experts out there who are so smart that they know. And, every cycle, some people will time it right in and out, but nobody does that consistently.
Yeah. And no matter how many degrees they have, no matter how many awards they have, whether or not they're a Pulitzer Prize winner or not, nobody knows when this is going to end. It will end, but we just don't know when.
Yeah.
So,
and yet, when just one other comment is obviously the stock market's way down, the bond markets, that's the big difference this year, is the bond market is also down hugely at the same time the stock market is, because interest rates were at 0 and they're going up, which makes the bond market go down. So it's double pain this year. But it's a great time. It's a relatively great time to buy because bonds are cheap and stocks are cheap. They're on sale. And my partner here always says, the stock market is the only market that when everything goes on sale, people run out of the building screaming. It's like, it's a good time to buy. May not be the bottom, but it's a much better valuation than it was at the beginning of the year.
Exactly. Okay, let's get on the outline. Okay. By the way, we welcome Q&A. This is the last session. So if you have a question, please type it in.
So we're going to just frame the session this time with a kind of a case study, maybe a typical client situation. And one of the things that I just want to say that I remember I didn't say about finding the right advisor is, I think it's so important to interview more than one. You may really like the first person you interview, but everybody, even the good advisors, all work a little differently, have different personalities. And we recommend that you talk to 3 different people. So if a client comes in to us, this is a situation, 72 years old, retired, total net worth about 4 million, 2.5 of that is liquid, 2 children and 3 grandchildren. We want to know, first of all, they need to find the right kind of advisor, and then we'll see what kind of questions we ask them. Fee only, fiduciary, CFP, do that FINRA check, the ADV, the Ask First form, interview 3 potential advisors. So clarifying the goals, that's one discussion that should always happen in the first meeting. It's often a situation that precipitates somebody coming in. It could be a death, it could be an inheritance, it could be a grandchild born, something that has changed in the situation, or you're just really fed up with trying to do it yourself, or an advisor who's perhaps given you bad advice. A lot of times we're just asked to look at the situation to see if, we think it's normal. And, everybody's should be down right now. It's that's a given. So maybe that's not a problem. Maybe you're down more than you should be. Maybe you're taking more risk than you should. So this particular couple needs help investing their retirement funds. And again, a lot of people are focused on that part of it. But making sure the money will last is important. Obviously, getting your estate in order is super essential. And this couple wanted to gift to some of their favorite charities. So those were their primary goals.
By the way, it's making sure your money will last is the #1 concern from consumers, outliving their resources or having to lower their standard of living or changing their standard of living. And so a lot of individuals always look to income and, totally, and sometimes don't look at their assets. how
right.
to make their assets more
Very few
productive.
people can live on dividends and interest alone, and it's not very good planning to try to do so because that's the least tax efficient way to get your retirement income.
Yeah,
So you
and
need to look at all your assets, and it's not a simple, straightforward calculation. It's a big difference if all your assets are in retirement plans versus in taxable accounts. Obviously, if all your assets are in retirement accounts, they haven't been taxed, so you can slice, 30–40% off of that probably. And it matters when you run the numbers to see where the assets are, inflation, what assumptions you're using. It's all about the assumptions. And you can run an online retirement calculator, but are you putting in the right assumptions for your situation? There's a lot of things to consider.
let's go to the next slide.
How long you're going to live is important. So starting out, let's see.
By the way, how long do you let your clients live, Laura?
So 100 is our default, and we have people tell us they're not going to live till 100, and we'll do it 95 maybe. We'd rather err on the side of having too much money in the end. And the financial planning and running those simulations is not a one-time thing. It's a process. It's something that you need to have done on an ongoing basis. We typically run it every 2 or 3 years for clients, unless something changes in the situation, then we do it more often.
Yeah.
And once your advisor's done it once, they should have all the baseline information in, and it shouldn't be that hard for them to run another projection based on, you sold your house and you moved, you upgraded, downgraded, something like that.
And that's why it's important for this particular slide that you have the proper information if you're going to run the numbers.
Yeah. So what we'd like to do, first of all, is put together a balance sheet to make sure we're capturing all the information. Your home, your other assets, do you have rental real estate? Do you have a loan on the books to your cousin? All that kind of stuff would show up on the balance sheet. And then we can update it over time and see how that plays out. So your balance sheet is your assets minus your liabilities. That gives you the net worth number. But it's a good way to track your assets. So super important to put that together. Reviewing cash flow and spending. I say that this doesn't mean putting you on a budget, just trying to see where is your money going. We have a worksheet we usually provide people so they can look at that and really get all those categories down. We can tell a lot just looking at a tax return, and that's super important. Having, if your advisor's not asking you for a tax return, they're not really able to do financial planning. It's likely they're not doing very comprehensive financial planning. That's such a key piece of information on everything. And there's a lot of planning opportunities usually to be found looking at a tax return. So this particular client, they have a pension, some Social Security. They've estimated their overall expenses $150,000 a year. So they need about $85,000 a year from their portfolio. Which is about 3.4%. And as Pete pointed out, that doesn't mean you need to have a portfolio that gives you an income yield of 3.4%. You want to look at the total return on your portfolio. You're better off spending capital gains than you are income. So if you can produce more capital gains and less income, your portfolio is going to be more tax efficient. So it doesn't really matter where that comes from as far as the spending, but you want to do it most tax efficiently.
I think that's very difficult for people to do who do it on their own, because it's kind of like, oh, I'm spending the eggs instead, or I'm spending the chicken instead of the eggs, or it's hard for people.
And when we run those numbers, we could calculate for, you want to be sure you have 500,000 left when you're gone to pass on to your beneficiaries. That could be factored in, or some people say they want to spend it all. And you built it to spend it. It's your money, as we say. And a lot of times we see people denying themselves to give more and more to their kids. And obviously that's up to what people want to do. But I would just say in general, that's seems not very fair to you, and not necessarily very good for the kids. I mean, I can say that after 40 years of seeing kids who got more money than they should have and how that worked out. So that's something, that you should be able to have a discussion with your advisor. You need to be really comfortable having those conversations about those things. And a lot of times husbands and wives don't agree about it. So there's never a right answer on that. And that's an evolving process. And again, one of the things we usually recommend on the estate planning process, which we'll get into a little bit later, is, don't lock yourself into too many irrevocable type vehicles. You want to keep your estate planning pretty flexible so that you can make changes as things change down the line.
So the 3.4% return
Yes.
That number is not intuitive.
Right.
In other words, you had to come up with that number based on the crunching the numbers. And so when you're looking at an investment portfolio, you're looking at getting that kind of return or around that kind of a return.
No. So this 3.4 comes from the fact that they're getting 64,000 and they need 150. Okay. So they're going to need 85 from the portfolio, which based on the portfolio of 2.5 million equals 3.4%.
So given that you use that 3.4.
Yeah. So given that they need 3.4%, we're going to factor that into the number crunching. And maybe we come up with, because of inflation and taxes, they need a 6% return on their liquid assets. So that our numbers may show 6% return. And to us, that would translate to a conservative to moderate portfolio. We'll talk about that later. So that this helps guide really how you should invest. That,
so it really ties in together.
Everything ties in together. And that's the whole concept of financial planning. It's all related. And just looking at one piece of this is not as helpful. And you may be one of the lucky ones who has a CPA who does tax planning for you. It's not that common that CPAs do a lot of planning like this with their clients, but they're looking at it just from the tax lens. It's all about saving taxes and not looking at how the other pieces fit together.
Let's go to the next slide.
The next, what I always think of to look at, that we're going to look at first, is insurance, to be sure that what you have is protected. And that is, your medical insurance is important. Long-term care insurance, yes or no? Do you have something? You've got to review that. Your auto, homeowners, and personal liability insurance. Just about everybody should have at least $1 million umbrella liability policy. Probably cost you a couple $100 a year. And life insurance, do you have it? Do you need it? Do you have, you need to review what you have. Most people have, I see, more than they need, and weren't, they didn't necessarily, they were sold something that may or may not be the best fit for them. But one of the things that a good advisor will be able to provide is good resources. We spend so much of our time vetting resources. When we make a referral to a Medicare supplement, a salesperson, advisor, or something like that, it's a risk to us that it's not going to go well, and it's going to reflect on us. So, we take a lot of time to vet the resources that we have, and we have resources for all kinds of things. We have somebody asked me what was one of the more unusual ones. And we have a car broker who can find you the car you want, and negotiate with different dealers, get you the good price, and drive it to your house and show you how to use it. And super great process. And he's so busy. If you ask me for his name, I don't even know if I'll give it to you, because I'm barely getting my clients taken care of. But we have a lot. And if anybody knows anybody else who does that besides Rami, I would love to know. But that we take a lot of time to have resources for all these different things. And then, of course, we want feedback from the clients on how that goes. And we want to be involved in the process. We want to be sure that you're getting the thing that you need. But I think one of the most important things is that liability insurance, that umbrella liability insurance. We see so many people who don't have it, and part of the reason is it's a small premium amount, so it pays a really small commission. And I just read recently that in California, they're supposed to recommend earthquake insurance. They're supposed to have the discussion.
They don't.
And I think somebody told me that was the same with umbrella policies. I don't believe that's true.
Yeah.
So you usually have to ask for it.
Yeah. One other thing on this is that I usually ask, do you take or give referral fees.
Yeah, that's another, yeah, because you can say you're fee only, but then you take referral fees.
Yeah,
And that
I don't want,
includes,
I don't want a referral where you're getting a referral fee for making the referral.
right,
So,
and and actually Schwab and Fidelity and TD Ameritrade, all of those brokerage firms, when they're giving you the name of an advisor, that advisor's paying them a referral fee. They're splitting the fee with the brokerage firm. So just FYI on that. I mean, I assume that they're disclosing all that, but
yeah, on their ADV form, they disclose it, but that's probably the only way they do. The financial world is full of conflicts. And you want to try to minimize those conflicts. And that's why we keep on emphasizing a fee-only fiduciary advisor, because if you're just paying one individual or one firm and there's no one else, the only obligation is to you. And so you hopefully avoid many of the conflicts. And if there is a conflict, you discuss it.
right. And just, one more thing on life insurance, people who have old life policies, a lot of them have blown up and they're at risk of running out and not being funded right when you might need them. So most agents will sell a life policy, and once they think they can't sell you anymore, they kind of go away and they don't really manage your life insurance policy. Your life insurance policies need to be looked at every once in a while to make sure that they're financially sound and they're still going to be there. Or if you don't need them, is it make more sense to cash them out?
Let's go to the next slide.
So tax planning, super important. These are just a few things. Qualified charitable distributions, QCDs, are something a lot of people are doing. If you are taking your minimum distributions, required minimum distributions, you can make a charitable donation directly to a charity and avoid the tax on that. Super cool planning technique. There's a lot of complexity around that. I think doing your planning earlier in the year rather than later is important because you can get tripped up a little if you take too much QCD before the RMD and all that. So you need a plan around that. But if you're going, you're going to make charitable deductions, you can do that pretty easily directly to a charity from your IRA. Batching your charitable contributions is one way to do some good planning around the fact that California's had so many of our itemized deductions limited. If you can have more of them in a given year so that you actually go over these thresholds, then you might actually be able to deduct more. So we have a lot of clients who give their charitable deductions, they kind of front load them and do them every other year into a donor advised fund, and then they could give annually through the donor advised fund. And if you're not familiar with the donor advised fund, you need to make sure to attend the It's Your State series, which will tell you all about donor advised funds and community foundations and how those can be wonderful, easy ways to make donations. We get asked so much about Roth IRA conversions. It's something that we look at every year for our clients. It's very rare that it makes sense. Basically, you are electing to pay taxes before you have to, which is generally not a good idea. But sometimes you may be in a very low tax bracket, in some cases even a zero tax bracket, and it may make sense to do a conversion up to a certain amount. There are situations where it makes sense, but it's you need to have you need to do the planning, and we work closely with the client's CPA. And if we ever look at something like that, do an analysis, make a recommendation, we will work with the other professionals on the team to get their opinion, to make sure that they agree that that makes sense. And I think that's a great way, that's something to ask your advisor too. Would you work with my CPA? Would you coordinate with them? Would you help, work with the estate planning attorney? I think it's important to have a good team that can work together. Tax loss harvesting. It's 2022 has been a great year for that. We've traded more this year than the last 10-ish probably, because we're doing some tax loss harvesting. It's an opportunity to rebalance the portfolios. The idea of rebalancing is you're selling when things are high and you're buying when things are low. But at least you want to take the opportunity of capturing some losses to offset gains now or future gains. So there should be lots of kind of planning going on in your portfolio around that. And the tax bracket planning, that's the case of batching your charitable deductions, a little bit like that. The Roth IRA conversion kind of plays into that, where, you know, if you have the ability to decide to take income or not, or take deductions or not, you can work around the tax bracket so you can maximize a lower tax bracket before bumping up against the higher bracket. So that's a lot of what good advisors are doing this time of year, is kind of all the tax planning, anything we need to do before year end to make sure that we're taking advantage of the market volatility. And moving on to investment portfolio, if you've been to the other sessions, this shouldn't be the first time you hear this. And I do need to say before Dawn interrupts me that this does not include charitable gift annuities. Charitable gift annuities are awesome. They're a great planning technique, but commercial annuities, index annuities, variable annuities, there's so many names, are really don't make sense hardly ever. So the only time, you know, I'm always asked, like, you know, when does it make sense? There's a particular type of annuity, an immediate annuity, may be called an income annuity, but that it may not. Can't be careful with that. But it's where you are agreeing with the insurance company, you're giving them your money, and you're going to get a lifetime income in return. That could make sense in some situations. We've used that when people barely have enough money and they need to be sure their money is going to last. Sometimes making that deal and getting an immediate annuity could make sense, because then they will have lifetime that's guaranteed. However,
we had that situation Laura, with an individual who owned a Berkshire Hathaway stock, and her husband took it from Dow Chemical, only took a one life pension plan.
Right.
So when he died, all of a sudden, there wasn't a base or secure amount of income that they were used to before. So she turned that Berkshire Hathaway stock into a charitable gift annuity that paid her very similarly for the rest of her life. And she was a real fan of the Pacific Symphony, and the money when she dies went to Pacific Symphony. So
you're going to be much more likely that they're going to do you good if you're working with a charitable gift annuity and a charity than you are with an insurance company or a broker.
And at the time she was getting 11% return, and that's not counting the income tax deduction. Right.
And you know, the annuity, the typical commission on annuity is 7% of the amount you invest. It can be much higher. There are still annuities on the market where it's a 25% commission, and invariably the salesperson will tell you there's no cost. You're not paying it. There's no fee.
Yeah, the line is the insurance company pays me.
Yeah.
Well, if you go to a car lot and buy
right, if you want to get out of it the next day, how much money are you getting back? That's how much it costs you.
Usually the surrender charge gives you a clue as to how much the insurance person is getting paid.
Right. So it's usually at least 7 years till you get out. And that ties into how much the insurance person gets. And every little bell and whistle you add, every little bonus rate, or every little, you know, this much of a bump, that's all a higher commission and more of your money that you're going to lose if you want to get your money out. So the problem is, once you get into these, there's no good way to get out. The worst thing is there really aren't tax benefits, except you don't pay taxes until you take money out. But when you take money out, it's the worst possible tax treatment.
And it doesn't get a step up in basis.
Yep. You don't eliminate the income taxes at death like you do with other assets.
I hope everybody listening is convinced just to say no to annuities. Let's go to the next slide.
Sorry, I mean that is the number one piece of advice I could give you, is just say no to annuities. So outside of that, how do we kind of start looking at the investment process? There are a lot of different approaches that firms have. Some firms don't really even look at asset allocation. They are just going to buy, you know, large company value stocks, large company value stocks like Berkshire Hathaway. They're going to buy a bunch of stocks that they think are the best stock. They're not going to look at, the bigger picture first. They have a certain approach that works. That works in some cases, not usually for individual investors. Most professionals are going to take an asset allocation approach, which is really looking at the bigger categories before picking the components that go into the categories. So first of all, we figure out, we're going to use stocks, bonds. Are we going to count real estate in this, cash? What asset classes are we going to use? And then make a pie. And then you rebalance the pie. So these are very typical portfolio names and models. I think Vanguard uses some of these same names. Many advisors use these same names, and each advisor will have a little different twist on it. But this is fairly standard. And I always look at the moderate growth, which is 60% stocks and 40% bonds. And and there's been a lot of talk, oh, it's not working this year. Well, nothing's working this year because bonds have been hammered just about as much as stocks. But over time, the moderate growth has been a good portfolio. It's kind of the standard endowment model. And, you're going to get a lot of the market return, but you're going to have 40% of your portfolio that's a little more protected long-term in bonds. If you don't need the return that a moderate growth will get you, you could go to conservative growth and flip that where you have 60% stock, 40% bonds. If you're super, super risk averse, or you have plenty of money and you really don't even need a return, you might go to stable. If you're still working and adding your portfolio, or you're a more aggressive investor, you might go to growth. So we would say a stable portfolio long-term may give you 4 to 5% return. Conservative would be 5 to 6% return, moderate 6 to 7, growth over 7. And that has held true for 40 years that we've been doing it. And we've actually, a portfolio like this has actually exceeded those returns quite a bit because of bonds. And we don't expect the returns of the last 40 years to be what they are going forward, not because we think the stock market returns are going to change, but because we think the bond market returns are going to change. Because we started tracking and investing in 1980-ish, when interest rates were at 18%. Mortgages were 16%, crazy. And they went to zero. So bonds had a crazy 30, 40-year run where you made a higher return in bonds than is normal. Now we're in a more normal environment. Bonds are expected to produce less return going forward. So the returns I told you are kind of what we think we look at long-term. And those returns that we're using are going to tie into the numbers we run on your spending capital needs analysis. So if we're thinking you're going to be moderate, we'll say, okay, we're going to plug in a 6% return on your investable assets.
Yeah, one of the things too is that we're living longer. So, age really has a lot to do with it. How long are you going to live and be in the market? And with bonds coming back up, I have been seeing a lot of 70-30 kind of portfolios in the past. Yep. So probably now with the bond prices going up, do you think we're going to go back to a more 60-40 kind of portfolio for individuals who are 70 years old?
Everybody's different.
Yeah.
Everybody's different. And, we use these as general models and then we customize. But it's interesting because I'm on a large foundation board, a national board. And a few years ago, we flipped from the 60-40 moderate to a 70-30 because an endowment fund has the longest possible time horizon. We figured we could take a little more risk on the stock side. And, if you've been investing for a while and you can get comfortable with the market swings, and it takes a while, it takes going through it, I think, a few times. It's interesting because we have one client who started with us, I guess, the beginning of the pandemic, and he inherited a lot of money. And it's just been the market volatility of the last couple of years have kind of been torture for him. And I think, we have the same conversations. He knows he has, because he saw it come back in 2020 to 21. He knows he has to write it out, but it kind of takes going through it. And once you kind of get, oh, this is how it works. The market goes up and down, but it goes like this. It's up, down, up, but it says eventually, I mean, long-term 90-year history, it goes up. And if you don't need all the money in your portfolio, well, we wouldn't be letting you invest it if you needed it in a short-term period. And it's at least 3, if not 5 years. If you need that money, you shouldn't put it in the stock market, maybe not even the bond market, maybe just cash.
And it's another reason to stay away from individuals who call themselves a financial advisor who are under 30 years old. You know, because
you can have those people on your team, but you need
on your team, you can.
Yeah,
But you have to experience a down market before you really understand it.
Yeah, and I've been using my experience a lot in conversations. And my first, big market downturn was 1987, Black Monday. And I was actually sitting crying at my desk. It wasn't easy. And of course, I'd never seen anything like that. And just some interesting things around clients. And, one of my clients was still kind of damaged from that, I think. But, I was kind of like, well, the market, I don't know, should I invest? And I kind of said, you just got to jump in. And we took half of his money and invested it like the week before. So he was not in a good place. But lots of conversations later, we agreed to invest the other half within a week or so of that. And so he was whole. It took a few years, 3, 4 maybe. And he didn't need this money. He was in his 30s and still working. So you don't want to invest money that you need in the short term. And otherwise, the markets are, there's still value in the underlying holdings unless you're investing in some really crazy things.
So a good advisor holds your hand and prevents you from doing the wrong move.
Right.
And we expect by the way, don't you think that's just as valuable?
Yeah, for sure. And there's some kind of well-known studies in our industry. I think Vanguard's done the one that's been used a lot to show like the return of average investors on their own versus the return of investors working with advisors across good advisors, bad advisors, all advisors. And it's typically 2 to 3% more a year, which really with an advisor, because you're not making the wrong decisions at the wrong time. And I mean, I've done it through enough cycles to have learned a few things. But if I was out here doing it by myself without a team to talk each other through a peer group that I can go to and say, what are you guys thinking? And in 08, 09, I mean, we're going to have something else. And I always say that the risk, we plan as much as we can for that, but the risk is the thing we can't see coming. It's going to be different next time. It was a pandemic last time. Now it was like over, too much stimulus money and, world problems. And next it could be, who knows what it is. And you have to have a portfolio designed for who knows what's going to happen, knowing that fundamentally, the underlying assets are worth something. And, as in 08, 09, I remember telling someone who was, in the top 10 people of a huge publicly traded company, super, sophisticated investor, saying, just driving over a bridge in Switzerland, saying, you don't understand, Laura, the world is ending. It's over. And I was like, no, Walmart isn't going to zero. They're still selling diapers and shampoo tomorrow. It's like there's still value to these companies. I mean, it was, the frenzy. And then I needed to go back to my team and my peer group and say, what are you guys doing? Nobody's caving, right? It's tough and it is scary, but the US economy is still the strongest economy. We do invest internationally, but we are way overweighted in the US. It's still the best, most stable economy to invest in. And over time, the stock market has given 10 to 12% return annualized through the depression, through the financial crisis, through everything.
Through World War II.
Yeah, World War II, everything. And you just have to write it out and make sure that you keep enough liquid to meet your spending needs. So that's part of the analysis we do, so that in a time like now, we can tell clients that you have enough in short-term bonds or cash to meet your spending needs for 7 or 8 years. Do you
So
think the
that-
market's going to be up in 7 or 8 years? And, you know, we don't have to sell stocks into a down market because we have enough to cover the spending.
So if the question is, and it
Yeah.
is, how do you put money in the market with a big lump sum?
That is a great question. Do you know, if you have a chunk of money to invest in a lump sum, do you do it all at once? So I think through experience, we used to be do more dollar cost averaging in, because you could invest it all and the next week, you know, right before the market declines. So you could maybe invest a quarter of it over 4 months, over a year. So we look at that on a case by case basis with clients, and yet the market goes up way more than it goes down, and studies will show that, you know, you risk missing out by dollar cost averaging in.
Yeah.
You know, over time you're gonna be better off just putting it to work.
But it's
think we're comfortable
psychologically,
doing it.
that's difficult.
Yeah, so we usually won't do more than half in the same, depending on where the market is, in the same week, and if there's more money coming in.
Yeah, when I have a client sometimes or they have inherited money, and so I'm the fiduciary making those with a fee-only advisor, making that decision as to how much to invest in the market at any one time. And you have studies upon studies that show putting it in the market immediately and getting it to work is the best methodology. However, psychologically, it's very difficult to put all the money in and knowing that the following week the market could go in half or in a third, and how does that affect the client? So I do exactly what Laura.
But I'm gonna add one point to it, and I think it's something Laura's been talking about. First of all, have a plan. Where are you going to put the money? I know when we sold our building and we're putting money in, and here's this lump sum, they said, we're not going to do the lump sum at one time. We're going to put it in over 8 weeks. And so they did. Over 8 weeks, we put the money in. And as soon as the 8th week went in, let's see, December of 18, the market crashed. And gee, I'm glad we waited the 8 weeks to feel the pain. But
Yeah.
you know, but again, it was a plan. And yes, that happens. And yes, it came back and was very nice afterwards. So
Yeah,
you know,
I usually do quarterly. I don't do weeks.
Yeah. Yeah, you know, and that's a situation. I mean, the how you split your pie should really be based more on your circumstances than your emotions and your risk tolerance. But the risk tolerance is important. It's a part of that. If you really can't handle much volatility, we're going to push you a little more conservative. But I think the emotional part of it comes in with things like how fast you want to invest it. Are you comfortable, you know, taking that risk, or should we go slow with the lump sum, for example?
Let's go to the next slide, Laura.
I was just going to say, you know, I'm comfortable enough with the market volatility that I've been 100% stocks for a long time. And I don't recommend that for most people. I have a couple clients who do that. And one of my clients who wants to be 100% in stocks all the time is 87. But he's been through enough markets that he's comfortable with that. But again, we start with moderate and kind of go from.
But you're still working and you're getting income. So
Yes,
that's
yes.
So,
Yeah.
so look at
See
this.
how I change when that stops. So,
see this asset allocation chart.
This is what we might call a sub asset allocation. So the others was just stocks, bonds, and that's where we start. And then we go more granular. Again, everybody's going to be a little different on this. If you buy the Vanguard Lifestyle Moderate Growth Fund, your portfolio is going to look quite a bit like this. I mean, this is a very common allocation, I would say. We also do use alternatives occasionally, but most people don't need to do that. There's some reasons not to, but this is a portfolio without any alternatives. And again, large company stocks, mid, small, developed international, the big, you know, Japan, Europe, stocks, emerging markets, which are more, you know, China, India kind of markets, US core bonds, just basic bonds, and then non-US bonds. Foreign bonds have been a good place to get yield until the recent
Should
past.
most consumers have a pie so that they understand their own diversification?
Yes, and I think any report you get from whoever you're working with, even the brokerage firm, should be showing you some sort of pie. I mean, that's where we start with our reporting. You know, and I know, looking at the pie, what the return should be, you know, in a given market, because it's pretty predictable how it's going to perform. And I'm often asked about tax-free bonds versus taxable. If you have a taxable portfolio, it's likely that municipal bonds make sense rather than corporate bonds. Of course, not in an IRA. You shouldn't have municipal bonds in an IRA. I see it still all the time, and you shouldn't have an annuity in an IRA. And
Okay.
unfortunately, half the annuities are in IRA.
So if you're with a broker or a financial advisor and you don't understand your asset allocation, you pay them to help you understand this. And that's part of the service. And so, and you pay them a lot.
And if you're not comfortable asking your advisor questions, you have to get a different advisor. I mean, it's so common that there's so many not great advisors who make people feel intimidated or kind of discourage questions or talk over it, around it. It's like, you know, the more that you understand, the better investor you're going to be, the better clients you're going to be. It's like,
you have better communications, and
right. And
you know, and there's a lot of terminology in this, and it takes a while to understand it all. So,
and working with an advisor where you're paying a percentage of the assets, an ongoing fee like that, that's why that's a good model, because we're getting paid ongoing, not just when we put you in the portfolio in the beginning. We're managing it on an ongoing basis, and we want to interface with you a lot throughout the whole process. It's not like a lot of places where you go and you're sold the investments and then they're not watching it. They don't want to talk to you until they can sell you more. So, you know, paying your advisor on an ongoing basis, you're paying them. You should be getting the communication and advice that you need.
Okay, so you had made a passing comment a moment ago, and I wanted to let you be the one that answers this. Why shouldn't you put municipal bonds in an IRA?
Because you get a lower yield on municipal bonds than corporate bonds, because they're tax-free, and an IRA is already tax-free. So you're getting no benefit, but you're getting a lower yield.
and then when you pull in the money,
Yeah, wait a minute. An IRA is tax-free. I'm not sure I would state it that way.
Yeah,
I would say you get no.
tax-deferred.
Yeah, thank you. I was going to say you get no advantage
A
of
Roth
having the
is tax-free.
because
But
when
but you will pay then ordinary income taxes
on
when
all
you
of it.
withdraw. Yeah, when you pull it out,
Right.
it is horrible to see municipal bonds in an IRA
or an annuity.
or an annuity in an IRA. You automatically know that this particular quote unquote advisor is nothing but a salesperson.
Yeah, that is egregious. And actually, it means like and if you're working with a traditional broker, and that can look a lot of different ways, they have Monday morning meetings, and the big brokerage firms, they have certain chunks of bonds that they need to sell and get into client portfolios. And even if they're stuffing, tax-free bonds in a tax-deferred vehicle, they don't care, because they got to allocate those bonds and sell them or invest them in their client portfolios. So that's a sign. That's a bad sign.
If you get anything out of this 6-part series, out of the workshop series, is that the financial world is a sales world, and that's where you don't want to be. You want to be in that continuing relationship, the service, rebalancing, and why don't you pull up the next slide? Because I think these are kind of the questions that you're going to be discussing with your financial advisor.
And Pete, I want to say, I know you always say this, but it's like, I can't tell you how often people will say, but she's really nice over at that bank, and she seems smart, but she's so nice. Like, oh my gosh. It's like,
I'd rather than go out and have a drink with her.
Yeah, it's not about, well, yeah, I'm sure they get wined and dined. And
yeah, that's the way to do it.
Yeah, free, if there's a free dinner involved before you become a client, like run the other direction.
Yeah.
So this is could be called a capital needs analysis or retirement, projection, whatever. We call it sustainable spending, because that's what we're really trying to make sure. Like, if you have this much, if especially you're retired, that's all you're gonna have, or you're working, you're adding X amount. How much do you need before you can stop working, and how much can you spend when that happens for the rest of your life, with inflation and everything. So, and we will factor in, a new car. Okay, you're one who needs a new car every 5 years, or you're going to buy a vacation home, or you're going to sell your house and downsize. I mean, if you're working with a real advisor, it shouldn't be a plug in 3 numbers and spit out a projection. It should be taking your particular situation into account in great detail. And we will usually ask people, what are you spending now? What do you think you're spending? And we'll, go through using a spreadsheet that they can fill out, or they are pretty sure, I know it's this amount. Or we could solve for, given you have this much, what's your maximum amount you could spend? That's probably what we're doing most likely. And I think for most people, it's, some people are overspending, and it's a good checkpoint to say, you're going to run out of money at age 89, to know that. And we do have a few people in that situation that we need to keep, working on to make adjustments there. But more often than not, we find people are able to spend more than they think, or they're not spending enough. And, as we say, we're going to be with them along the way, and we're going to make adjustments, and we're going to look at this every couple years. And we take it very seriously. We worry about clients running out of money way more than they do. We're going to make sure that they're on track. And this is something we check in on every time. And as I said, rerunning the numbers every 2 to 3 years, unless there's a extenuating circumstances.
And,
so
and it doesn't matter how much you have, spending is psychological too. And
yeah.
I'm depressed, so I'm gonna go out and buy something, or Amazon. I can go on, at 1 o'clock in the morning and make myself feel better.
Well, so, and what people will spend money on and not is super interesting. I mean, and usually spouses are not aligned on that. Some people think it's crazy to spend X amount on a pair of shoes, but they wouldn't think twice about, upgrading to business class on a flight or something. I mean, everybody's very different.
Everybody's different.
And, that's okay. It's okay to have those things and kind of realize what they are. If some of it's out of control, we may see if there's an opening to have some discussion about that. But, by the time we're working with people, usually the habits are pretty ingrained,
I think my parents, when they were, I don't think they went to a store if they didn't get green or blue chip stamps.
Yes.
So, everybody's a little different. Let's go to the next slide.
Yeah, I would say one of my clients I was visiting up in a mountain area where I was hiking and with a group of friends, and they have probably 35 million net worth. And she pulled out from her drawer all these coupons, and she gave me a 10% coupon for Vons that, she was going to give up to let us have it for our hiking trip week. And she still put the coupons. That it doesn't change. Just a couple comments on this. We normally don't put the house in this analysis. We figure that you're going to stay in that house or have a similar house unless we know otherwise. So we're looking more at the liquid investable assets. We're going to factor in Social Security and any increases. And there's there used to be more options around, or strategies around when you take your Social Security and spouses, claiming and all that. There's still a couple things you could do. There are some good online tools out there, but an advisor should also be able to help you with that. It's very personal depending on your situation and your health outlook, but in general, you want to delay it as long as possible because it makes sense unless you have a shortened life expectancy.
And, we're talking about the gifting. We're not just talking about gifting to charitable organizations, but it's wonderful to be able to gift to grandchildren and to help one of your adult children start a business, but I recommend highly that you see a fee-only advisor before you do it, so that it's more, besides the fact of an emotional gift, that you make it a little bit of a business transaction as well.
Yeah, we end up helping a lot of clients get notes in place that, you know, they have with their kids when they're making a loan for a house or something. So we have a promissory note that we will put together, help them put together. And I think it's great when you can help, you know, at a time in their life when they probably need it more than they're going to need it when you're gone. And also it's a way for you to see how they handle money and how you might want to set up your estate with how much control or not control, depending on how your kids or grandkids.
Yeah, but I think that
money.
that's a real issue with a lot of families, at least that's what I see. And it always reminds me of, you know, when I go on a flight and they say, you know, when the oxygen mask comes down, make sure you put it on yourself first. And then if you have a younger child, then you go to the younger child. And I think this is about gifting as well. Make sure you take care of yourself first.
Right. And, you know, we see a lot of problems and abuse in this area. I have unfortunately, a lot of personal experience with it in my family. And your advisor can kind of, you know, help you mediate some of that and be like a gatekeeper. You know, no, I've checked with my advisor. I really can't afford to give you another.
Let the advisor be the bad guy.
Yeah.
I see an immense amount of financial abuse, especially when somebody gets in their 80s and 90s and the adult children are having some financial problems. And
and it's tough because mom or dad, they need the family there to kind of look after them at this point, and they may have some healthcare issues and they don't want to alienate the kids. So it's very tricky. It's
I see grandchildren. We're not going to let you see the grandchildren until you give me money. I mean, that's how blatant I've seen it. So,
oh yeah. So just one thing is just as far as gifting that we see all the time, if you just put your child's name on your house, you've given them a gift of half of the value of your house. And that's okay, but you need to file a gift tax return. You won't.
You need to understand what you've done.
But you can't just do that. And it's not necessary. It's usually not a good planning technique. So there's usually better techniques. And just as far as the annual gifting, the $16,000 a year that is in place this year goes to 17 next year. So next year you can give anybody $17,000 a year. You and a spouse could give $34,000 a year without having to declare it and file a gift tax return.
Yeah. Let's go to the next slide.
So estate planning is kind of, you know, super important, but we've kind of got all these other pieces in place. And now let's look at the estate plan. You need to have something in place. You know, most likely are going to be able to change almost everything. Get something in place, and it may not be perfect, but you can change it later.
Well, you know what I talk about is like between spouses. If they don't have a durable power of attorney for each other, they can't make decisions if one of them gets Alzheimer's, Parkinson's disease, or has a major cancer bout. People think about estate planning that it's about death. No, right. It's about when you get older and you need help. And
super important.
Yeah.
And those documents over time, the standard documents, they may be okay, but they change. They improve them. It's really good to revisit those and make sure you have the right people in the right slots.
Yeah, I get a lot of questions regarding should I see an estate planning first, attorney first, or should I see the fee-only financial advisor first? What I usually recommend is to see the fee-only advisor first. And I recommend highly that the fee-only advisor is involved in the estate planning.
Right. And estate, estate planning attorneys are, they have conflicts of interest too. And they're transaction driven. They sell documents. They're not paid on it. In most cases, they're not paid on an ongoing basis. And they are worried about estate taxes, and they're gonna CYA also, often recommend all kinds of stuff that may or may not be appropriate.
Yeah,
And a lot
just
of
so
times
you,
we've had to
yeah.
unwind some of that, so I'd rather be involved.
Yeah, there is no such a thing in California as an asset protection trust. And I see it advertised all the time. It's just makes it more difficult to get to your assets, but there is no way in California you can
Yep.
protect all your
Yep.
assets.
So I was
And
in an all-day tax seminar yesterday. It was in
lucky you, lucky you.
Phoenix, and it was online. I wasn't able to go live, and it's hard to sit through anyway, but definitely online. It's very long, but I was kind of pleasantly surprised to see this well-known estate attorney say the same thing. And most of you don't need to protect you need to protect your assets maybe from your kids, but not from lawsuits, unless you're an OBGYN, you're like in a really high risk business where you are very likely to be sued. Most people aren't at risk of being sued for all their assets. An asset protection trust is not really what you should be worrying about.
Yeah. And legacy trust, that's another one. These are fees in perpetuity trusts.
Yep.
So,
And that was another thing this guy talked to, and he just said the dynasty trust and all that. It's like you're planning for generations you don't even know. Like, do you really want to go through all this expense tying up your assets, and you don't even know who these people are that you're trying to build this huge estate for? Like, it was interesting that he was agreeing with that.
yeah.
So
well, but we have a whole workshop on estate planning, so I don't want to get into the details too much on this, except for have your fee only advisor involved.
Yeah. I mean, we go to many of the meetings with the clients, and I think somebody had suggested having the meetings in the advisor's office and letting the attorney come out to the office, which I think has worked pretty well. We definitely like to be in the process, and we will, want to look at the documents before you sign them to make sure they make sense, and then we're there to translate, because it's not always that easy to see what happens. But that reminded me of another thing that comes up for us a lot. When your children turn 18, you have no legal right to know anything about them, including their medical situation. And I've known of some horrendous situations of, the child in life support after overdosing, and the parents drove all night because nobody would answer anything. And they still, they had to fight for 3 days to get into the hospital room. So, you can get healthcare, you could get agreements from your child before you pay to send them off to college to allow you to get information. You won't get information from the school. You won't get information from healthcare providers. So
have that advanced healthcare directive.
Yep, the advanced healthcare directive to allow you to get information, even if the kid isn't comfortable, naming you to make the decisions. Hopefully they will be, but at least to get information about the situation is super important. Yeah. And then, of course, there's all kind of tracking things on the phone. You can see where they are.
Don's telling you that you have 10 minutes.
Okay.
And by the way, Thanksgiving dinner is coming up. So this is a good time to talk a little bit about this stuff. Okay. So,
and a good advisor, could help facilitate a family meeting. I mean, that's a common thing, just where some of these things might be difficult to talk about. That's something I think I'm in a better position to really talk up mom and dad and how they created this wealth, and what some of their ideas for, and open it up for them to talk, open it up for the kids to talk. Ideally that happens. Some families are just set up and have a history that doesn't permit that, and you have to work around that. But I think it's good that at some age the kids might know what's coming.
And by the way, this happens in $500,000 estates and in $100 million estates. So people equate money with love, and how number one reason for divorces is about money. So it's estate planning is an important process.
Estate planning is so important, and I'm sure you guys have heard this. There are no trust police. If you don't like something, or if your beneficiaries don't like something, they have to resort to litigation to get it solved. It's crazily expensive. I mean, we've had a couple very abusive situations that we saw or were brought into. And, you know, the good trust litigators that I've run into, I mean, we got someone down from an $80,000 retainer to a $20,000 retainer before they would even look at it. And, you know, just like any litigation, nobody really wins except the attorneys.
Yes.
So,
Let's
you
go
know,
to the next slide.
having your estate planning dialed in is important.
I think we probably know this already, so let's
Okay.
move on.
All right, charitable gift planning. So cash, even though I think I just read 80% of all gifts given are in cash. 90, and only 6% of overall assets in our country are in cash. It's the, you know, worst, any charitable gift is good, but, you know, giving cash is the worst gift to give. If you have, you know, appreciated real estate, if you have appreciated stocks or mutual funds, that's a great way to give, and doing it through a donor advised fund makes it really easy. If the charity, you know, maybe a small one that isn't able to accept stock, every advisor should be very familiar with how this works. Try not to wait until the last minute, like it's getting late in the year to do that if you haven't done it already. And then, you know, bequests at death, there's different kind of charitable vehicles you can set up. There's different things you could do at death. When you go into your estate planning attorney, this probably isn't top of mind unless you've done a lot of planning already. You're thinking about your family and who's getting what. But I would suggest that you think about, because somewhere in your state, if all your family's gone, you know, at least you're going to have a charity at the end of the line, hopefully somewhere before the end of the line. But think about it, and don't necessarily take your attorney's input as far as what charity to name. And I see that all the time. Wait, I didn't know you had that kind of relationship with this organization that you're giving them 200,000. No, my attorneys, and of course I looked up, and the attorney's on the board, you know, well-intentioned, but it's your money. And something to think about is, what do you care about, and what organizations? And again, an advisor can help direct you to some resources to look at some different options for that. And community foundations are great for that.
Yeah. And by the way, in just besides the money, it just tells your heirs what's important to you, you know, in life. And I wish I knew what my dad thought was important. And so the charities I always encourage you, if you're going to name a charity in your trust or in your will, put a line in there as to why. What does it mean to you? Why is that meaningful to you? And
yep, and that should be able to be incorporated in your trust documents. And also you can do side letters, which we love.
Yeah,
just like separate from the trust, a letter with things like that, why this was important, why you set it up this way, especially if there's any things that aren't equal.
And there are a lot of advanced planning techniques.
Yeah,
I'm not going to go into them.
Most of them don't fit for most people.
Yeah, charitable gift annuities, charitable remainder trust, charitable lead trust. And Don is our philanthropic advisor, and he'll run a calculation for you at any time at absolutely no charge and no obligation. Let's go to the next slide.
And a lot of the charitable advanced planning strategies, I want to say, most of them are structured so you get some money back, or your beneficiaries get some money back. There's other advanced planning strategies that really make it very difficult to change or get your money that, you know, maybe about tax avoidance and that kind of thing, but it's a lot of give up of control.
Run the numbers.
Run the numbers. So my 10 recommendations for financial success: work only with true fiduciary fee only advisors who aren't selling insurance or anything, not getting kickbacks from anybody. Focus on asset allocation, not stock picking. You know, very few stock pickers are successful over time. Don't time the market. You know, I mean, I could say now's probably a good time to get in relative to earlier, but
it could go down another 10%.
Go down, and you know, once you're in, plan to be in for a while. Invest tax efficiently. Indexing, using index funds, and I know you've covered that in another session. Tax location, put the right assets in your tax deferred IRA and the right ones in your taxable accounts, muni bonds, and for many taxable investors. Maximize any contributions to retirement plans. I still can't believe how many 401ks I see where there's a match and they're not taking advantage of it. just some crazy things like that. Really take advantage of any company benefits that are still left out there. Don't buy annuities, don't borrow to spend. So, borrowing to buy a house is borrowing to invest. That's a mortgage loan is good debt. Borrowing to shop at Nordstrom's on your Nordstrom's card, and that's a bad debt. That's borrowing to spend. If you pay it off every month, that's fine. But borrow to invest, maybe, but not to spend. Save for college in a 529 plan, much better and more flexible than the UTMA accounts, which used to be popular. Have a will or trust, have something in place. You can usually change it, and don't worry about the wrong risks. As I said, we gave a couple of examples of that today. Worrying about the FDIC insurance on your funds is in most cases, you don't have to worry about Wells Fargo, Bank of America, Chase. They're not going under, not to spend a whole lot of time driving around town putting money at different banks. As we had somebody, she was at 28 banks.
Yeah. Don't stop listening to the conspiracy theorists.
Yeah. There are a lot of risks out there.
Yeah.
I would worry about the earthquake risk. A big believer in earthquake insurance. So I was in San Francisco for the earthquake last week on stage speaking. Yeah, that was fun.
Yeah. To give you, I love your 10 recommendations, and in my own practice as a professional fiduciary, I reduce my fee during a client's lifetime in half if they have a fee-only fiduciary financial advisor. That's how important it is, I think, to have somebody there who understands everything there is to know about, most things to know about money, and can run the numbers and do things as intelligently as possible.
Great, agree. Great note to end on, for me at least. Thank you to the charitable sponsors, and hand it back to you guys.
Come online. Don, do you ever get called Donald?
Let's see. My grandmother used to call me Donnie Bill, if you really want to get into that one, but that's maybe, never mind, we won't go there. Virtually, yeah, only to people who have no clue what my name really is. And they're looking at something that says Donald on a form. That's sort of, to me, like saying, thank you for your patience. I have no patience. Don't say that to me.
Donald.
Yes. Peter, what would you like to talk about now? Anyway,
is there any questions coming up?
You have done a wonderful job of answering as we have gone through. So no, there are no questions. I just want to make a really good note, incidentally. Thank you very much, Laura, for what you did. And this has been a wonderful week 6, the final week of It's Your Money. The videos are all online. This one will be on probably by next week. Since I did in fact turn on, and I kept looking at the whole time. Are we recording? Yes. And we certainly have good sound this time, which we had on one session. Thank you. So Pete.
And these all will be online. So at iyme.org. So if anybody wants to take a review and go through it a little bit slower, or they missed a part, and don't hesitate to email Don or Laura or myself if you have any follow-up questions.
Yeah. Thanks.
Thank you very much.
Yeah.
Thank you, group.
Thank
you. We'll see you in the fall.
Oh, there's a question.
Great series. You're being complimented, Pete. You don't need to talk about it.
I thought there was going to be a question.
Thank
Okay,
you.
have a good one. Take
Bye.
care. Bye-bye.